Okay, very good morning. Monday the 7th of August, so good to be back after a week off. I think one of the main things that I saw on my Twitter feed, obviously can't get enough of Trump tweets coming out thick and fast as per usual, but I did catch the kind of headline release of non-farms, and it's my first chance really to have a look at some of the charts to see how that was reflected. And obviously I read about the Dow breaking 22,000. Pretty unbelievable how quickly we've got there, and we'll look at some of these equity charts shortly. But one of the most interesting, I think, infographics that I saw is this one, and of course it was the World Athletic Championships in London at the weekend. Usain Bolt failed to capture, I think it would have been his 20th gold medal, but check this out. This is the fastest times ever run in the 100 meters in the world. The struck out lines indicate the ones who have been banned for taking illegal substances. There's only one person who's ever run legitimately the fastest times in the world, and as you can see, Mr. Bolt is the only person. I don't know if you saw that with Justin Gatlin getting booed, but nearly every other athlete he's ever gone against that's run anywhere close has been found guilty of cheating in previous times. So, well done to Gatlin anyway for beating Bolt at the age of 35, but nonetheless, pretty incredible, the amount of the drug issue in athletics. But anyhow, back to the markets. And looking at the equity markets this morning, we're a slight positive once again. This came obviously on the back of payrolls on Friday, as I understand, a headline reading of 209,000, quite a bit higher than expected, 180. The unemployment rate ticked down as expected to 4.3. But importantly, the average hourly earnings in line month on month, but the year on year was a tenth higher than expected at 2.5%. And as we'll know, having monitored and traded non-farm payrolls over the last few months, is that wage component, which has proved to be quite critical for the overall performance. But the fact that you've got basically a downtick in unemployment, an uptick in wages, more jobs being created, just on those three measures alone, you're looking at a solid reading in that respect. And I can see in my dollar index chart the dollar moved substantially higher. One asset that suffered then, obviously in the wake of that, I can see, was the euro. But I guess the euro is a bigger story, because if you start looking at the euro-dollar pair in the journey and where it's been really since the Centra conference, that was that ECB forum, if you remember, back on, I think it was the 27th of June when that took place. So if you start stretching out this euro chart, let me put it on a 90 and then we'll get a better sense of where we've been. So the Centra speech that he gave when Draghi first time really in many years sounded supremely optimistic about the economic prospects for the euro area going forward. And that was when we were trading really around a 112.5 type level in the currency pair, and at that point, people were calling maybe a bit of a revision to forecasts to 115, given the political impasse on Capitol Hill in the context of an improving economic situation in Europe. 115 seemed like a pretty good target for the euro. And you can see we got there pretty quick after that speech. In fact, within about 2 days. We then had a brief break of that level, but it held around 115, only then to accelerate all the way up over the last week towards close to really 120 type area. The high, of course, being up at this point that we traded here around 119.41. We've pulled back slightly though, and certainly what I'm suggesting here is that just the size and speed of this increase has meant that it was inevitable that if there was going to be a spring back on the dollar, which we saw the catalyst being non-farms on Friday, then euro-dollar was always going to be susceptible to some pretty aggressive downside price movement. You can see that on Friday the price came down to those previous low points that were seen back on the 31st on the morning of. And we've just seen a bit of a bounce and recovery thereafter. Pivots provided a bit of a barrier on the upside on the move higher during the Asia Pac session. That pivot level kind of lining up roughly with around the lows that were seen back on the 1st and overnight on the 2nd. So it could be quite an interesting level should we move back up and towards that kind of zone, if you like. Consequently, cable following suit. Some downside pressure obviously on Friday. I can see here after the data hit, just where we're trading at the moment, there has been a little bit of sterling news that's developed over the weekend. First of all, let's get down to the bigger story, which undoubtedly is this one. And this is talking about an article that appeared in the Sunday Telegraph. You might have seen me tweet it, but if you didn't, then the summary is this. A report in the Sunday Telegraph said the UK planned to offer £36 billion or 40 billion euros, partly in the form of continuing budget contributions during a 3-year transition deal with Brexit. So this is talking about this key issue that essentially Brexit negotiations have really gone nowhere thus far, because whatever the UK's negotiation team tries to do gets blocked by the EU with a pretty steadfast rule that you must settle the money that you owe us, basically this settlement bill or divorce fee, before we'll then move into talks about a transitional deal and then ultimately going on to more crucial trade talks and so on over the coming years. And so it's the first time you're really hearing a bit more of a legitimate type number put out there. And obviously it had ranged previously from 100 billion from the Euro side down to 1 billion from David Davis a number of weeks ago. And so here we reside now kind of towards the midpoint at 36 billion. Now obviously this has had quite a severe backlash from the anti-European type politicians who are of the stance of, you know, why should we pay anything type of situation. But ultimately I feel that this is somewhat inevitable. We are going to have to pay a fee of some amount in order to get this deal done. The thing that's come out this morning to really round off the Telegraph story was that the Telegraph one was citing 3 unidentified sources for their detail. The FT this morning saying that the UK government themselves officially have insisted it will pay no more than it needs to in its divorce settlement with the EU, playing down a report that it would offer then 36 billion if the bloc were to start negotiating a Brexit trade deal. So hasn't really been too much of a repercussion on the market price, and that's the fact that, as I just said, I don't think this is really that surprising. Of course, in terms of what the media are going to make of this, is a really big pushback that this ultimately is a bad decision. You know, where's this money going to come from? Obviously, the UK economy is on the back foot at the moment amid this kind of slow economic slowdown that we're going through amid the high inflationary environment and the weak wage situation, which is denting consumer confidence and the ability to spend. But even though the government might play down these reports that are in the Telegraph, I do think that ultimately we are going to have to pay this fee, and I don't think this has really caught financial markets by much of a surprise. So more so, I would say it's more about just tracking the economic data, and then with this situation with the politics, it's kind of just monitoring it as and when it gets released, no real set schedule. But I'd still reckon it will take another few weeks before we get down to the nitty-gritty of finalising this divorce fee. But I think the market's kind of priced this in to some respect. The other thing that's come out for the UK overnight is this. UK economy takes a hit as consumer spending slumps further. And again, no real kind of dramatic sell-off in the pound on the back of this, because it's really just confirming a trend that's already been in play. Expenditure falls for a 3rd month. This now marks the worst streak since 2013. This is according to IHS Markit, the data provider, and Visa, the credit card company, and the report they've published today. So this is looking at the chart here of year-over-year growth, and you can see then that the state that we've been in really since this was the Brexit situation, and actually we had a surprising pickup at the time. This was probably the knee-jerk reaction of high street hugely discounting in order to counteract this downturn in potential consumer confidence and spending. But then since then, as inflation has picked up, that's really impacted the consumer to the point where now spending and intention on that side continues to sit in negative territory to points that we've not really been at since really late of 2013. A couple of comments which came out obviously late Friday. Bank of England Deputy Governor Ben Broadbent said the maximum rate of pain for consumers will soon pass, though any improvement could be modest. So still holding out at this point that the inflation, having seen it, you remember it dipped from 2.9 to 2.6 in the UK, saying that actually that's could be now the top of the inflation spike post EU referendum vote. And so therefore this spending situation will come back towards kind of a more neutral rate rather than this negative trend. So definitely something to monitor. Fundamentals still seem quite, I would say, bearish for the pound. Certainly more so than the euro, which generally speaking, economic performance still remains relatively good, certainly in comparison to that of the UK. So downside today, just keeping an eye on the intraday low, Friday's low I should say, that was printed down at 130.41. It's probably the first area to be looking at should we move any lower from this current point of where we're trading. Below there, probably not then the next bigger levels until we get down really the 130 handle psychologically, which also is the S1 on the day, and then 129.56, which is around S2, and also the low back on the 20th. Just going back to the equity situation though, and obviously we just mentioned the Dow. I was just looking at the Dow. Obviously I was away last week, and I just put a line on the chart here at 21,631 was when I left the office on the 27th. And you would have thought 22,000, just given directionally the trend that we've been seeing, just gradually moving higher, 22,000 would have been inevitable at some point or another, but got there pretty quick. And we can see we're still sitting above that level. The pivot today is pretty much at the 22,000 handle, so maybe that could be quite interesting as a support point for any pullback in prices. But the stat that I saw this morning for the S&P was the S&P 500 has now seen, well, this is looking at the Dow. Let's look at the S&P here and put that longer dated, because the consolidation that that's been in kind of validates the stat I'm just about to share with you. And really, you're looking at this portion of the price movement here. This is what tends to happen when you get the consecutive pushes higher. It tends to, you get a period of consolidation followed by then a push and then another consolidation phase. That's certainly been the trend in the S&P, and we've now seen 12 successive closes of less than 0.3% in either direction in the S&P, which is a record with daily data going back to 1927. So I remember there was one day, I think, when we dropped about 1%, and everyone thought that this was the beginning of the apocalypse because we fell 1%. Well, if you remember in the financial crisis, 1% would have been an extremely quiet day. Whereas now, in comparison to this kind of ultra low volatility environment, 0.3%, a move bigger than that at the close would mark a pretty big swing in markets. But the thing is, we're coming into obviously the midpoint of August, and this is when typically the markets go into a bit of a summer lull. In terms of timing, the first week of a month tends to be the most busiest in terms of economic data, bookmarked by non-farm payrolls, and that's what we had last week. This week, the week after non-farm payrolls, tends to be particularly quiet. And so could be the case. Therefore, you need to keep this in mind when you're thinking of your strategies about the kind of expectations and targets that you should be looking to execute with your trades, specifically in the S&P if you were looking at that index. Looking elsewhere, oil prices, not really a great deal I can see going on right at this moment. We're sitting kind of around pivot 49.22 type level. If we look slightly longer dated, I can see that we got up to around this kind of 50-40 type level. This was back on the 1st of the month, and we've kind of, the new range if you like is the 48 really to 50 and a half, and 50 providing a pretty good level back midweek last week on the 3rd. 50 obviously being psychological as well, so pivot to the $50 handle, which is also looks like R1 on the day. It would be a pretty good range I think to look at. But in terms of a news perspective, there are a couple of things to look at. Output cut compliance. I saw the latest numbers this morning, which I found quite surprising. I knew that compliance was dropping, but this is a pretty quick drop when you think that only about 2 or 3 months ago compliance was in excess of 100% for OPEC nations. Compliance now at OPEC has dropped to 78%. This compares to 82% from the 10 non-OPEC partners. If you remember the graphics I was showing you a few weeks ago, OPEC was far over compliant than non-OPEC, and now it's reversed. Iraq, we know, has been a real key issue about they've been very bad at adhering to their predefined quota. Their reason or argument against that is because of the dramatic fiscal situation they've been put in amid the terrorist situation that they've had ongoing there for a number of years, and the loss of revenue for their government and the situation that's put that country in. Then also you've had Libya and Nigeria with the pretty rampant output coming back online, which has seen these compliance levels continue to decrease. The other thing that you've had here in 2 other news item perspective is US drillers reduced the number of rigs to 765 according to Baker Hughes. This is the second drop in 3 weeks. So if you remember, we had been seeing persistent increases pretty much for the last 18 months in US oil rigs coming back online, US output going higher and higher and higher. What we're starting to see now is the first of a bit of a confirmation of a trend. It's the second drop in 3 weeks for rig counts have now seemed to have hit a bit of a plateau, which makes sense, I guess, in terms of where the price is at the moment, because as we know, when the price got back down to 42 type dollars, where we're trading in mid-June, that even starts to put a bit of pressure on the shale producers about their long-term viability at the lower end of that price point, given their break-evens sit just below there. The other thing that we've had probably will help at least negate potentially some of the downside in the short term is Libya's Sharara oil field at the weekend, which is the nation's biggest. Statistically, I think they have approximately 300,000 barrels per day of that one oil field. They've stopped production after worker protest, according to people familiar with the situation. That developed, I believe, yesterday. So although oil is down slightly on the session at the moment, we're down about 25 cents. That Libyan headline might get a bit of a look in potentially when the US come in. But on the downside, maybe just playing, given things are quite quiet, the low that was seen really defining the range of last week could be quite interesting. So around that 37 at the extremity, but then also around this 48, 49, 50 type level. Okay. Some other things so you're aware from the morning. We have had some economic data out of Germany. Not that this has got much of a look in. If anything, as I've been speaking, I can see the Euro's had a little bit of a break of the overnight highs and pivot on the upside to reverse some of that Friday loss. But German industrial output registers biggest decline in 6 months. This actually came in at minus 1.1%. Expectations were for plus 0.2. So quite a bit weaker than expected. But as you will see, this data point, although it had been printing positive numbers for what is 5 consecutive months prior to this last reading for June, it does tend to see some pretty dramatic, sizable swings in performance. And hence I think it's just being brushed aside, more largely or not. One other quick thing I wanted to just talk to you about, which is not so much in focus right now, but it's something to just be aware of and will likely become more of a predominant theme as you go forward, and that is European politics. Obviously after the Macron victory, it's kind of taken a bit of a backward step given the more pro-European candidate, so that kind of populist movement seems to have died down, at least in terms of a media agenda, if you like. But we have the German federal elections, and now that we're in August, they're only about 6 weeks away. But before that, one thing I just wanted to show you was a graph of approval ratings for Donald Trump versus Macron. And I found this quite astonishing, really, because Macron has seen his approval ratings plummet in the last couple of weeks to a level of which he's not much better than Donald Trump, which I find incredibly hard to believe from sitting here in London. The kind of toing and froing of the administration team that we've seen, the revolving door at the White House, never seems to be stopping in recent weeks. But Macron has seen a pretty sharp drop-off. Now, this isn't completely unexpected. It's quite common for freshly elected presidents to see their popularity fall post-election. Certainly that is the case in regards to France. But this is pretty dramatic, what we've seen here in July in particular. Now, if you remember, back a few weeks ago when we were in July, that was when we had that surprise story where Macron came out and said he wanted to make an €850 million cut to military spending in France. And that saw a pretty stern kind of fight back from the head of the military, who had been in place for many, many, many years. He said this was utterly ridiculous, massive big public argument and spat between the two, which led to the eventual resignation of the head of the military. And since then, really, you've seen quite a severe pullback in Macron's popularity. But this might be something to keep an eye on. I don't think the market's paying too much attention at this point. As I say, historically, new presidents, after all the kind of fanfare that you get in the run-up and the post kind of win celebrations, it does tend to fizzle out. But if that continues to decrease, this could become interesting for the point that Macron does need to still ensure his reform agenda can be pushed through the National Assembly. So he wouldn't want to continue to lose too much popularity. On the German front, what I've seen is the EFT now, as we go in towards the German federal elections in September, they've started to put together now their poll tracker. You guys will be fairly familiar with the looks of these from the recent UK general election. But this might be something to just keep half an eye on. If we were looking at this back at the beginning of kind of 2017, you'd be thinking, wow, this is really a threat to European stability, because this was when Germany was fighting with a real issue of immigration because of heightened levels of terrorism in the country. The number of Syrian refugees they were taking on was politically being very difficult for Merkel to manage. But this was all preceded that, of course, of the French election and also the Dutch election, which saw very high risk of potential far-right representation in their respective parliaments, which has not materialised. So since that point, the Euro kind of synergies, if you like, between these countries, particularly with Macron and Merkel forming quite a tight relationship, has seen now the CDU party move back into more being more popular, and they've diverged quite sharply since the beginning of the year to now a fairly significant lead for Angela Merkel's Christian Democratic Union and its Bavarian sister party, the Christian Social Union. So they should, as the polls suggest, comfortably remain the largest party against Martin Schulz's SPD. Now the SPD, if you remember in the press quite recent, have taken a further dip because of one of their senior politicians was said to have sounded out the board of Volkswagen before delivering a speech about the emissions scandal that's been ongoing, which kind of, VW is such an important part of the German society in terms of the amount of jobs it creates, the amount of money it generates, and so on and so forth. But that party has come under some pressure given the fact they've been pandering, if you like, to the corporates, particularly when there's been that of foul play at hand, and that's been a negative in terms of public sentiment towards that government party. So something to just be aware of going forward, for sure. Okay, in terms of the calendar for today, Monday, as ever, post non-farm payrolls is particularly quiet. One thing I would keep in mind is that although economic data, there's not really a lot to speak of. We do have some speakers. Fed's Bullard speaking specifically on the US economy and monetary policy. Bullard is a non-voter, but nonetheless, just given the context of the speech, I would be mindful of that. 4:45. Kashkari is a voter and participates in a Q&A, but that'll be later on after the European close. And there's one thing that's not mentioned on here, but you need to be aware of, is that there is an OPEC, non-OPEC joint technical committee meeting in Abu Dhabi taking part today. I've tried to have a look for some times of when we might see potential comments, but I've not really seen anything definitive. But I'd just be a little bit mindful of keeping an ear on the squawk or monitoring tweets that come out of various journalists and so on, oil minister comments that might come off on doorstep comment type fashion. One thing I'd say is that this is a technical meeting for OPEC and non-OPEC nations, so I'm not expecting anything groundbreaking to come out of this meeting. This should just be talking about the compliance issue at hand. Unlikely you're going to hear an introduction of caps for Libya and Nigeria, an issue with Iraq about how they're going to be forced to become more compliant, deeper cuts, extension of cuts, that sort of thing. Very unlikely to happen in actuality, but could well be talked about. So worth just being aware of. This is the week in its entirety, and I thought I'd just quickly share it with you to get a bit of a feel for what we're looking at. And as I say, overall, there's not too much on the data slate. The real thing that catches my eye is on Friday. That's when you get the US CPI reading. US CPI obviously crucial because this is the core CPI measurement that we're looking at here. We'd seen a pretty clear trend lower from the highs of 2.3% in January, tracking all the way down to then stabilizing here at 1.7%. And the key is this now the bottom of this decline? Are we going to see a stabilization or even a movement back towards 1.8 or above? This is obviously what's needed for the Fed to enaction their kind of sequence of plan about balance sheet normalization in the coming month, and then a final interest rate hike, which their intention is still for the end of the year. But absolutely critical that inflation does not fall further from here, which would jeopardize those plans. So the CPI data on Friday, very important for the Fed. That's probably the most important data point that will be coming out. For FX traders, you have got the Reserve Bank of New Zealand have got their interest rate decision as well, midweek. But we're littered with other central bank speakers, predominantly from a Fed perspective. The two that I've just mentioned, Kashkari, Bullard today. You got Dudley on Thursday, Kaplan, Kashkari again on Friday. A couple of RBA speakers as well on Tuesday and Thursday. So quite a few things there just to be aware of that could be interesting to monitor. Okay, guys, that's your briefing. Going to leave it at that for today. Any questions, as per usual, me or the guys happy to help in the chat room. Okay, have a good day and have a good week. Thank you very much.